Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the numbers even when they're buried in legalese. And let me tell you, this ethanol producer called Highwater Ethanol has a story to tell in their latest report, and it's not all sunshine and biofuels. Our deep dive today comes from their filing reported on July 31, 2025, covering their quarterly performance. This isn't just about a company selling ethanol, it's about the roller coaster of commodity prices, agricultural markets, and how a business navigates those ups and downs. And believe me, there are some ups and downs here. Let's get right into the juicy stuff, the financial tables. And the first thing that jumps out is the balance sheet. As of July 31, 2025, Highwater Ethanol had total assets of about $71.7 million. Now that sounds like a lot, but compare that to October 31, 2024, where they had assets worth nearly $89 million. That's a significant drop. Almost $17 million less in assets. What does that mean? Well, it usually means they've either spent a lot of cash or their liabilities have gone down substantially. So looking drop almost $17 million less in assets. What does that mean? Well, it usually means they've either spent a lot of cash or their liabilities have gone down substantially. Kannoking lakin literally means they've either spent a lot of cash or their liabilities have gone down substantially. You looking at the liabilities side, we see a big reason for that asset drop. Their current liabilities, the debts they need to pay off within a year, plummeted from over $18 million in October 2024 to just about $8.4 million by July 2025. That's a decrease of over $10 million. They've clearly been paying down short-term debts, which is good for immediate financial health. But it also means they used a chunk of their cash to do it. And speaking of cash, their cash and cash equivalents, or the money they have readily available, also took a hit. It fell from over $33 million in October 2024 to just about $13.8 million in July 2025. That's a reduction of almost $20 million in cash. A big part of this cash reduction seems to be linked to operational activities and major member distributions, as we'll see later. Now let's shift gears to how the company actually made its money, or in this case, how it lost money during some periods. Looking at the statements of operations for the 3 months ending July 31, 2025, they reported a net income of about $1.7 million. That sounds pretty good, right? But when you compare it to the same period in the previous year, July 31, 2024, they made almost $4.8 million. So a pretty significant drop in profit for that quarter. And if we look at the longer 9-month period, the picture gets even more concerning. For the 9 months ending July 31, 2025, their net income was just over $1.2 million. Now contrast that with a much healthier almost $4 million in net income for the same 9 months in 2024. That's a drop of over $2.8 million, or a decrease of about 70% in net income over 9 months. That's a big story right there. Where are these changes coming from? Well, their revenue streams are mostly from ethanol, dried distillers' grains, and corn oil. Ethanol sales are their biggest earner, making up about 75% of their revenue, but even their revenue from ethanol sales decreased by nearly 9% in the quarter ending July 2025 compared to the year prior. The average price per gallon of ethanol was also down about 10%. The company blames this on lower corn and energy prices, but they also mentioned that trade disputes and possible tariffs from countries like China could really hurt their export business and add to price volatility. That's a major risk factor they're pointing out. Their distillers' grains revenue also saw a decline, dropping by over 13% in the quarter. The price per ton was down and they sold fewer tons. This is directly tied to the price of corn and soybeans, and also unfortunately to demand from places like China. Corn oil sales were a bit of a bright spot, increasing by over 26% in the quarter. This was thanks to higher prices, likely driven by increased demand for biodiesel. However, they sold slightly less corn oil. So it was a price pickup rather than a volume pickup. Now let's talk about what it cost them to make their products. Their cost of goods sold, which is basically the cost of raw materials, and production actually went up a little bit by about 1.2% in the quarter. Their biggest cost is corn, making up almost 81% of their cost of goods sold in that quarter. While the price per bushel of corn went up a bit, they used less corn overall because their ethanol yield improved. That's a small positive, but it doesn't fully offset the lower prices they got for their ethanol. Natural gas is another big cost, making up about 4.5% of their expenses. The price per MMBtu went up about 9%, and they used less natural gas, likely due to lower production of those distillers' grains we talked about. Their operating expenses, things like salaries and overhead, stayed pretty much the same. They seem to be keeping a lid on these costs, which is good, but they state these expenses don't change much with production levels, meaning they're a fixed cost they have to cover regardless of sales. The other income net category, which includes things like interest income, also saw a drop. They made about half as much in other income in the 2025 quarter compared to 2024, mainly because they earned less interest on their money, which makes sense given their lower cash balances. Looking at the 9-month period ending July 31, 2025, the story is similar but amplified. Total revenues were down just under 4% compared to the same period in 2024. Most of that drop came from distillers' grains, which were down over 22% in revenue. Their cost of goods sold for the 9 months actually went down by about 1.7%. This was mainly because they used less corn and their corn prices were roughly the same, but the lower revenue in distillers' grains and corn oil meant their overall cost of sale went down. However, with lower revenues and slightly higher operating expenses as a percentage of revenue, their operating income took a nosedive. It fell from nearly $3 million in the first 9 months of 2024 to just about $500,000 in 2025. That's a staggering 83% drop in their operating income. Digging into the cash flow statement for the 9 months ending July 31, 2025, they actually used about $7.5 million in cash from operations. This is a huge flip from the $8.4 million in cash they generated from operations in the same period of 2024. This really shows the squeeze they're under, where it costs more to operate than they're bringing in from sales, at least on a cash basis. A big reason for this cash burn from financing activities is those member distributions. They paid out over $8 million in distributions in 2025 compared to over $16 million in 2024. While they reduced these distributions, it still highlights that a lot of cash is going out to the owners. Now, let's talk about the risks, and Highwater Ethanol is very clear about them. They specifically call out that trade disputes can lead to tariffs on their products or the commodities they use. They mention that current trade policies and potential renegotiations of trade agreements create a lot of uncertainty. Retaliatory measures by other countries could hit ethanol exports hard, and this is something they can't predict but could significantly impact their business. On the debt front, they have a significant loan facility with Compeer Financial. While they currently have no outstanding balance on their term revolving loan or their revolving line of credit at July 31, 2025, they are subject to strict financial covenants. These include maintaining a minimum working capital of $9 million and limitations on distributions to members based on that working capital. The report states they are meeting these covenants now, but also warns that if unfavorable market conditions persist, they could violate these terms, leading to default and potential foreclosure on their plant. That's a pretty serious warning. They're also investing in upgrades like a sieve bottle and an EVAP Zero to improve efficiency, which will cost about $4.2 million. They plan to fund this from operations and their existing debt facilities. So what's the overall picture here for Highwater Ethanol? Well, they are clearly facing a challenging market. Revenues are down, profits are way down, and they're burning through cash in their operations. The volatility in corn and natural gas prices, coupled with the uncertainty around trade policies, creates a very risky environment for them. They are managing their costs and they seem to be trying to improve efficiency, which is good, but the market forces are pushing against them pretty hard. The significant drop in cash and the warning about loan covenants are red flags that investors and stakeholders should pay close attention to. They're in a tough spot, where a few bad breaks could really put them under pressure despite the long-term potential of biofuels. What's your take on Highwater Ethanol's situation and their ability to navigate these market headwinds? Let me know your thoughts in the comments below. If you found this breakdown helpful, smash that like button. It really helps the channel, and subscribe for more in-depth corporate analysis, and hey, join our Discord community for more discussions and to connect with other finance enthusiasts. The link is in the description. Thanks for watching, and I'll see you in the next video.